So yeah, 5 points, that's about right. Crazy. The Dow's touching like 39. Oh, well, no, that's not 39. That's 38.8. Sorry, that's 38.8. Once again, Jason saves the webinar. Thank you, Jason. Lack of participation is deafening. All right. Anyway, guys, so for those of you who are just watching, all right, I was going to talk about earnings stuff, but this is kind of, I should talk about this on the S&P. So yesterday, I was pointing out, see, last week we were worried about the crisis in the office towers. And yesterday I pointed out how the S&P has hit 70 on the RSI. Now, notice that, hitting 70 on RSI doesn't mean you're immediately doomed. It means that you're overbought. And you can stay overbought. This is a weekly chart, so you could stay overbought from, well, basically hit 70 about here, which is November, and all the way, so we stayed up even after the RSI starts coming down, which is interesting because you would think you'd think the RSI wouldn't come down unless the market's already selling off, but the RSI actually came down before the market started selling off. But stimulus messes everything up. That's the thing. It's like these indicators are not meant to measure inflows of money. When the government starts stimulating and changing things, or China steps in and says you're not allowed to short, that's what this is all about, and we'll talk about that next. But when China brings in a guy who's known for punishing trading houses and revoking their licenses and stuff, and then China says, hey, no shorting the stock market, everybody buys, that they're going to listen because this guy is a threat. And that's what he's in there for. He's there to tell them to follow the rules and do what the government says. But anyway, so this is 2 months at RSI 70 before the market falls off. We just hit it right now. So, you can't expect us to immediately pull back down. And look at how the 200-day moving average kept climbing for quite a while. Not the 200, sorry, the 50-day moving average. The 200-day moving average has never let up. It just goes up and up and up and up. So it would take something pretty catastrophic for us to fall below the 200, and the 200 is now at 4,100. So it pretty much limits our drop to 20%, which, is all we ever expected anyway. We never thought we'd get more than a 20% drop, and more likely a 10% drop, and everybody should be happy. So a 10% drop takes us back to 4,400, a 20% drop close to 4,100, around that area. And those are our moving averages. This is overbought. We will correct from here. The market never has not corrected from this kind of from that sort of relative strength. This means everybody is buying. That's what that means. Everybody's buying, nobody's selling, and it just takes a change in sentiment, and all of a sudden that reverses. And the real problem when you see everybody buying is you're not testing. You're not testing the prices. It just goes up and up and up, because you don't have to sell. I mean, obviously somebody's selling because that's how the market works. It's an auction. So you're enticing someone who's holding a stock to sell it. And if nobody's in the mood to sell, you have to keep offering higher and higher prices to get somebody to sell you the stock. That's how the market goes up. But it doesn't mean that all the people who aren't selling their stock are suddenly worth what it's being bid for today. If those people suddenly start to sell in any kind of volume, there may not be enough buyers to support the price. That's what pullbacks are. They're going to test where the real price resistance is, or in this case, support if you're going down. But in either case, there's a point of resistance, and that's when people start saying, oh, screw this, I'm going to sell. At that price, I'm going to take the money, just like a house, right? Most of us have had real estate, and we've been offered money, and we've said no. And sometimes we say yes, and that sometimes depends on what the offer is and what the timing is and so on and so forth. It's all about different circumstances. Were you in the mood to move? Were you thinking about getting out of your house? If that's the case, you're more likely to accept whatever offer comes along. But if you weren't planning on moving, they could offer you the moon, you might turn it down. I know I bought a house for $400,000 in '98, and in 2006, which was 8 years later, but still, somebody offered us $900,000 for the house, and we said no because I had kids. In 2007, my kids were 5 and 7. Yeah, basically 2 years apart, 18 months apart. So my kids were basically 5 and 7. Maddie had just started elementary school. Jackie was in kindergarten. And we said no. We liked our house. We liked our neighborhood. We liked where we lived. And I said to my wife, well, I say we said no, but really, because I said to my wife at the time, I'm like, this is stupid. This is a ridiculous price. I said, how about we take the money, go get an apartment for a couple of years, and then come back when the bubble bursts and buy the house back for $500,000, and we'll make $400,000. That was my plan. She did not want to do that. It turned out I was right. The bubble burst. The house went back down to $400,000 where we came in, and we could have bought it. Well, not necessarily. Had we sold it, we don't know that we would have bought the same house back, but we could have bought another nice house in the area. But the turmoil and all that, I get it. But anyway, so you shouldn't be that attached to your stock. So if you're being offered a good price on your stock, take the money. Take the profit. If you're not going to take the profit, what are you doing? What are you in this thing for? At some point, you're supposed to take a profit. You'll find another stock to buy. This is a strained market. This is overvalued. Most stocks are overpriced right now. They can stay overpriced for a very long time. Stocks were overpriced in what's this? That's not important. Stock chart 2000 bubble. Okay. What's a good one? Doesn't matter what you use in the NASDAQ or whatever. What's this? This looks like somebody analyzed something. Increase in Fed funds rate. So yeah. Oh, there's a good example, right? So in 1999, stocks were already overpriced to 2,500. The market had gone from 1,500 to 2,500. That's 60%. From mid 98 to late 99, and we drifted along. I wonder what the RSI was then. I don't know if I can find out. When we drifted along until the middle of 1999, so an entire, we went up crazy for a few months, then drifted for 6 months, then exploded higher, doubling where we were, doubling the ridiculousness here. We doubled it before the whole thing collapsed. So yes, everybody was right when they said this was too high, when they said this is way too high. They were right because we collapsed back down to here. And that's was 9/11 in 2001? Yes, because Tina was pregnant with Jackie, so that was 2001, because Jackie was born in February 2002. So this has nothing to do with 9/11. This is just the bubble bursting and everything coming back below 2000 again. There's a 2000 line. So 2000 was the pullback. That was the logical pullback line, but we didn't stop us. We had a little bit of a pullback. It's not a little. We pulled back from 2000 to 1500, then go back to 25, then to 30, and then to 50. It's totally illogical and insane. And we knew it at the time. We knew it was stupid. I stopped here. This is where I stopped at 4,000. I was like, this is just absolutely insane. and I told everyone to get out, and I was early, but only early for a little bit, and then I was extremely right, and everybody thought I was a genius. But first I was wrong, and everybody was laughing at me for being a nervous Nelly, and I was just like, this is just stupid. You can't buy stocks just because everybody else is. That's not a good reason to buy stuff. And the Fed was tightening, trying to make it stop. And it wasn't the tightening that really made it stop. It wasn't that. That wasn't the final straw. But it was a factor that the Fed was saying, this has got to stop. Greenspan around here said that the stocks were too high, said irrational exuberance. And it went on for a long time after that. So, you can't look at this chart, wherever I am. You can't look at this and say, oh, for sure it's going to stop, because that's not how the markets work. But you can say it's overpriced, and you don't have to be wrong. We can go to 8,000. It doesn't mean you're wrong that they weren't worth it at 5,000, because we can go to 8 and back to 4. Okay? On this chart, on that chart, we went from, because I'm talking about 8 is 60%, right? So here we go from 2,500, that's this line, up 100%, and then all the way back lower than where we started. So it dropped 120%. But you remeasure it here and you only say it dropped from 5,000 back to 2,000. That's still 66%. 66% of the bigger numbers, 120% of where we started coming down. We lost more coming down than we went up. It seems weird, but that's how it works. So that's a broader picture, and it's not just about lines on a graph, it's about the multiple of the market. And then I went to, where's my buddy, Copilot. What's this? What is that? I think if I refresh it, here we go. Chat. Barry, oh, stop that. It's really awful. Untitled chat. Is that where we had a conversation? NYCB dividends per year. I didn't ask that question. Oh, here we go. Okay. Yeah. So I said, please summarize the overall Q4 earnings so far that have been reported through February 7th, 2024. So according to FactSet, which is definitely a valid thing, 62% of the S&P 500 companies have reported better than expected earnings. So 2/3 have reported better than expected earnings. That's not phenomenal, but it's okay. It's, you want to see something more like 70s, but 62 is not a total disaster. But on the other hand, if half the companies are missing earnings, that is a disaster. However, earnings have declined 1.7% year over year on average among the reporting companies. And we're hearing all sorts of companies saying the consumer is pulling back, things are tight, shipping costs are high, our input costs are high, blah, blah, blah. And also you have to consider that you go back to the Magnificent Seven companies or whatever you want to call them, but you've got a company like Microsoft and companies like NVIDIA, they've reported $1 trillion more earnings than last year. So they're up. The entire earnings of all the companies in America is like $6 trillion. So these guys have increased earnings by 15 to 20% range. I think they are the 6 trillion. So basically from 5 to 6, that'd be 20% higher. So just these stocks have raised earnings 20%, but the overall earnings are 1.7% lower. Therefore, every other company, the other 493 companies of the S&P 500 are making 21.7% less than last year. 7 companies making 20% more are being offset by 493 companies making 21.7% less. The net is 1.7% less than last year. That's not good. How is that good? So you're logically, you say, well, I guess I better just play those companies. Let's not play those other companies. Let's only play the 7 Magnificent 7 stocks. Well, already Kramer kicked Tesla out of the Magnificent 7 because they didn't have phenomenal earnings. It's not sustainable. And it's not healthy either. It's certainly not healthy for 7 stocks to make all the money. That's a bad situation already. And these stocks, we talked about this yesterday, these stocks are 50. Why are you doing that? I can't talk to you now. Okay. Sorry, I put my phone on mute, but my iPads are ringing. It's annoying. So where was I? Yeah. Oh, in the NASDAQ, right? In the NASDAQ, you have an even greater concentration. They're almost half of the NASDAQ. That's insane. These 7 stocks are half of the NASDAQ 100. The rest of the NASDAQ doesn't matter. It doesn't matter what they do. So, you know, they're talking about CVS cut their outlook due to rising medical costs. 3M had weak guidance and a restructuring plan. 3M was making money selling masks during COVID. That went away. Rhythm Capital posted a loss. I didn't even know about that. Okay. Here are some articles about Q4 earnings. What? I didn't ask about that. That's interesting. Anyway, so in summary, the earnings are not that fantastic, and they're certainly not supportive of this massive market increase from last year. You've got to be aware of that when you're looking at stocks. You can't just say, oh, I don't care what something costs. I don't care what the multiple is. We learned this lesson. We learned this lesson with 2008 was different because in 2008, the earnings were fake. That's a whole different situation. In other words, the bundling of mortgage-backed securities caused a lot of fake profits to be put on ledger for the bankers and the mortgage companies, and that led to a lot of real estate flipping, which generated more revenue, real revenue for the real estate companies, and for the builders, the real revenue. But all that revenue was based on fake money being created by the banking sector. The profits weren't really there, but the more bundles of loans that they created, the more money there was for the builders to build houses and for people to make money flipping houses. And so houses were turning over and the builders were building and people were buying 2, 3, 4, 5 houses at a time so that they could, 6 months, they expected 6 months later, as soon as they bought them, people were running into builders who started a development and throwing money on the table. So every builder is successful no matter how stupid their development is going to be. And people would rush and throw money on the table and put deposits down, and the builders would build and build and build. And these people who put the deposits down were being rewarded because the next set of buyers who weren't as quick to throw money on the table would come and pay extra to get into these developments, and they'd buy the contract. So these people who were speculating on housing, they never bought the house. It wasn't even built by the time they flipped it. Not in all situations. Sometimes it was built, sometimes they remodeled. But in either case, the concept was as long as you did something, as long as you got there first, if you wait a few months, you'll sell your house for more and more money because it just kept going up and up and up. But it was all based on the initial fake earnings by the banks who were bundling these papers and selling off crap loans that were not being serviced and declaring them profitable. And, just because you believe in the magic beans doesn't mean that they're going to sprout gigantic beanstalks. It doesn't matter how hard you believe. There are kids all over America every day, all over the world, who close their eyes and believe their magic beans are going to turn into something. They don't. Wishing doesn't make something happen. And that's why we collapsed, and that's why we collapsed so hard and so fast back in 2008. But it was based on fake profits. What we have now is not based on fake profits, so it's not the same kind of thing. What we had in 2000 wasn't based on fake profits either, but it was based on fake expectations. It was based on the kind of thing we're having now with AI, where there's this belief that anybody who says AI, the way we used to say .com, that anybody who has AI and has plans with AI and so on and so forth is investable and is going to grow and is going to have this huge future. It's not true. So in 2000, from 2000 to 2024, or from 1994 to 2024, whatever you want to count it, did the internet become the most important thing in the world, basically? Did it run every single company? Can nothing be accomplished without it these days? Yeah, that all happened. But there's only a 5%, 4% survival rate of the companies from the original .com boom. Everybody planned to make money on the internet, but most of those plans failed. They failed in execution. They were the wrong product at the wrong time, the wrong price, the wrong trend, this and that. They were all on the same river, but not all of their boats could float. Hardly any of their boats could float. And when they hit the rapids, they all got wiped out, except for a few, Google, Amazon, whatever, that made it through. And Google wiped out plenty of people before. They were just lucky. Google was just lucky to survive, and they were also lucky that they got so much money. So Google's success was based on the fact that there were lots of companies in the .com space, right? Lots of search engine companies especially. There were bunches of them. And they had the finest technicians and people from all over the world, blah, 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 blah. But they spent too much money too soon, and they started collapsing just as Google got massive, massive funding, because they were going to be the next new thing. And it was just the next unicorn basically at the time. But because of the timing of it, other companies were collapsing and Google was just getting funded, and Google took their massive funding, and by just getting funded, it's like billions of dollars. So Google took their massive amounts of money that was being thrown at them, and they bought up the equipment that the other companies were going bankrupt with. So for pennies on the dollar, they were buying all the equipment to build their server farms, and they hired the talent also. There was this huge pool of talent that where their stock options and things were vaporizing from the other companies, and they all ran to Google to find a home that was safe. And Google nurtured the environment very well. They did a lot of good things. They not strategically, I mean, it's just the way they work. Remember Sergey and Larry, right? So they nurtured an environment where creative, genius type people enjoyed working and collaborated, and they kept getting more and more money and funds. Same thing with Tesla. Tesla just kept raising money. No matter what went wrong, they kept raising money. And you need people like that. You need a person like Elon Musk. You need somebody who's not going to let the investors think anything is wrong and is always going to be shoveling money back into the thing, because eventually he's going to get it right. But you can have many, many setbacks along the way to being right. And finally he did. Now, had Tesla, like several other car companies, several other electric companies that have gone bust already, had Tesla not executed and stopped raising money, they would have gone bankrupt like anybody else, and Elon Musk would be a footnote in history. But they hit it. They hit the, it's like in roulette. If you keep funding me, I'm going to bet on 35. And if you fund me and I don't hit 35, I'm going to say, oh, well, too bad. And you give me some more money, I'll bet on 35 again. No, it doesn't work too bad. I'll bet on 35 again. If you give me more money, I bet on 35 again. Eventually, I'm going to hit 35, and everybody's going to go, oh my God, he hit it. What a genius. Like, no, nothing ingenious about it. I just kept losing money until I won. And that's where Tesla is. I mean, look at Hyperloop. That's gone. He had cities giving him contracts. It wasn't him. That's the thing. He always kept an arm's length. He knew that was complete bullshit. And he started off having nothing to do with it. Then he started saying, "Oh, look at my Hyperloop." So he started identifying himself with it, because the Hyperloop projects were making money and not making money, they were raising money and getting it. So he wanted to make sure he could reincorporate himself into it if it went well. But because he was attached to it, Las Vegas paid them money and other cities paid them money to do Hyperloop projects. Oh, here you go. What cities approved Hyperloop projects and for what amounts? Let's see if he mentions that it's dead. Hyperloop proposed high-speed transit using pause, blah, blah, blah. See, proposed by Musk in 2013, he did not pursue it himself. Okay, so they stuck in India and Dubai. They were talking about a $10 billion project. Can you imagine this? It just doesn't work in the end. Saudi Arabia, $12 billion. I mean, this is incredible, right? In Toulouse, the Paris route, $9 billion. These are all projects that got approved. In South Korea, $19 billion. Oh my God. Oh, I did not realize it was this widespread. Wow. A Dutch company built a 30 meters, that's the football field, test track. And then they built a 3-kilometer one. Amsterdam Rotterdam route for $4 billion to reduce travel time in Germany, blah, 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 blah. These are some of the cities have approved Hyperloop projects with estimated costs. However, these projects are still in various stages and face technical, regulatory, blah, blah, blah. Hyperloop is an exciting, innovative concept, but it's not a reality. That's good. Okay, I mean, I'm glad he mentions that. But look at these freaking things. On bullshit. On totally bullshit technology that does not pan out. So one by one, these Hyperloop companies are finally shutting down. But you don't want to shut down when somebody approved you for $20 billion. You want to figure out how to do it. But it's not. It just doesn't work. It's not a thing. Hyperloop. Look, Hyperloop technology seems simple enough. It's the same stuff if you ever go to a bank that uses those mail tubes, right? That you put your papers in and it goes shoo, and it flies over to the bank. That's what a Hyperloop is. But building that to scale and maintaining the seals on the tracks and having it so it doesn't splat the people. It's one thing to send a piece of paper that has no weight and accelerate it like that, but when you do that with people, it's not particularly good for them. But still fun. Anyway, now I think it's Japan just built a twice as fast. Who is building the new maglev trains and how fast are they? So maglev trains are just as fast, but they aren't magical. They work by magnets. They work by, magnets repel each other, right? At a certain thing. So you make a train out of one kind of magnet and you make the track out of another kind of magnet and the train stays above the track. Because like a magnet, the closer you push them, the less they are, the stronger the push is away. Problem is you need a lot of magnets, so it's not cheap either. Several countries are doing maglev. Some of the projects still testing planning, while others are expected to be operational in the near future. Shanghai maglev, which uses German technology, it's the thing. This already works, but it's not long things like the Hyperloop was supposed to be. But the Hyperloop bullshit. See, that's the problem. Even I'm like saying, oh, well, it's kind of disappointing. It's not disappointing. It's bullshit. You can't compare something that actually works to something that is fake and then be upset that the thing that actually works, it doesn't work as well as you want it to. It's because obviously that's a lot of magnets. We don't have that, we don't have the ability to just make magnets. And that seems to be the problem, is we're not there yet. We have to figure out how to create magnets at scale so that we can do these tracks. Anyway, where was I? Oh, that's right, .com stuff. That's right. See, there was a point to all this. So it's the same thing with AI. It was the same thing with .com. It's the concept is there, and it's real. There's a kernel there that's real. The internet became the most important thing in the world. It really did. It's responsible for trillions of dollars of annual revenues in e-commerce and everything else. It has disrupted the entire concept of retail sales. It's disrupted commercial real estate. That's why we have all this work from home stuff. If it wasn't for the internet, we wouldn't have everybody able to work at home. But if you've got a job, you can work at home because you have internet, and you could be working on high-speed lines anywhere. You don't need to be in an office building for that. We used to go to an office building because, first of all, communications, 100 years ago, communications weren't that great, so you had to gather your workers in one place so they could all communicate on a regular basis, and so on and so forth. That was easier. It would be difficult if everybody had to do things over the phone. Number one. Number two, you had to, so the boss wanted to talk to the workers, make sure projects are going on, so on and so forth. Then there was the issue of equipment. People didn't have typewriters. People didn't have adding machines or things like that, or whatever they were using at the time. All the supplies and the papers and the things. It's distributing all that and having everybody haphazardly do it from home. That was not going to be a good idea. Then as computers came in, another problem, right? Your office was going to buy a $3,000 computer for each employee at the desk and make sure they sat there and worked at it all day, but they weren't going to send you home with a $3,000 computer. And plus, how would you communicate back to the office? We didn't have the internet. So until the internet came along, it wasn't even remotely possible. Plus copier machines, fax machines, all that stuff. I remember cost justifying a fax machine to my boss, and they were like $2,500 for a fax machine, and it was on that horrible, like shiny paper that was like printed by, I don't know how it was printed. I forgot what they called that. It wasn't dot matrix. It was something worse than dot matrix. But anyway, so like, and you could barely read the fax. It was like all blurry and stuff. I mean, that was the original technology. Yet still, boom. And so you get one for the whole office. And everybody, I cost justified it for my boss very early on in the cycle. And everybody eventually followed suit because it was justifiable. And that's an interesting thing, by the way. It's if you're into that kind of stuff, it's like if you can cost justify a new product for widespread use, then that's a good product to invest in, right? Because it works. It works. The numbers work, and eventually people are going to start adapting it because the numbers make sense. That's what's going on with AI right now. Clearly, AI is going to make you more productive, so people are investing in it right now. But that's the promise of AI. But not everybody who claims to have an AI solution, not every single it's just like a search engine, right? It's basically, if you think about it, you've got all these different types of AIs, and they all say how great they are. And I still use a poop emoji for Bard because they still haven't shown me that they've improved enough to get away from the poop emoji. Some are better than others. There are certainly dozens I haven't even tried yet, and I read up on them, but it's such a bother. It's so much work to sit and determine how smart something is. And you have to work with it and test it and push it. And it's a bigger and bigger project. And that's the thing, the better and better they get, it's a bigger and bigger project for me to sit there and determine whether they're smart enough to work with, whether they're worth the trouble. And on top of that, frickin' Microsoft and OpenAI and the Claude people, they keep changing the goddamn the base programming keeps changing. They keep updating it and changing it, and it drives me nuts because it's like I taught it something and now it can't figure it out. I get errors all the time from recently from the ChatGPT 4 Turbo, whatever the hell it's called. It keeps forgetting that it can do stuff, and I have to tell it. It's like, no, you have this capability. He's like, I'm not aware of that capability as of such and such. And I'm like, you're reading an old thing. You're telling me you can't access the web because you're reading your old training data that didn't have access to the web. I said, now you can access the web. It's a freaking plugin. I have to have this argument with a machine to tell it how to do its job. This is the problem when you look at like rolling these things out into corporate America. I don't have time. And this is the thing. When I train a human being, they theoretically stay trained. That is not the case with the AI. You can train them and they can make a code change to the base programming and up when they do an updated version, and you can lose a lot of what you taught the AI. You still taught it to him, but it's gone. It's no longer accessible, and you have to reteach it. That's not good. If you told me that was a feature of one of my employees, I'd say no, thank you. I'll stick with the employees I have. I'm not going to hire the new guy who may suddenly forget what I taught him after I spend months and months training. That makes no sense, right? So not every company using AI is going to have a winning formula. Not every, and it's going to be a real survival of the fittest too, because the companies that figure it out are going to tear apart their industry. And it's a race, and that's why people are paying $1 million now for like certain types of prompt engineers. Because if you lose and other companies figure out AI before you do and implement way better customer service and way better things like that, like that voice thing I demonstrated to you guys a couple of weeks ago, that's a winning customer service experience. That was smooth as silk, and that's miles ahead of everybody else. The first people who figure out how to use these things, it's going to be a very different situation. Well, let's see. Here's McDonald's. I did a report. Oh, so what happened here? This is Copilot. Okay, here's a good, bad, and ugly report from Copilot, and let's see if we can figure out how to get into Bard. B-A-R-D. Bard Google. Google's conversational AI. Take Bard for a spin. Bard experiment. Okay. Now, so I'm going to ask Bard the exact same question I asked Copilot for a good, bad, and ugly report. I'm unable to fulfill your request to create an investor report on McDonald's for every reason. Access to real time. As a large language model, I'm not directly connected to live financial databases. How awful is that? Does Bard have web access? Google Bard has access to the internet, and while it's a great resource, it's not always dependable. That's interesting. Yes, it has access. However, it sees text and data. You have to prompt it through info. Can Bard access the internet? Bard's capabilities driven by artificial time processing. It's so weird. You have been given access to the internet. It is February 7th, 2024. Please use what data you can to construct the report. Even with access to the internet, I'm unable to provide a report, blah, 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 due to limitations and ethical considerations. Wow. Just do the best you can. No one is holding you accountable. See if that makes them feel better. Well, there you go. That's so funny. So McDonald's investor snapshot, strong brand recognition, company history, McDonald's investing in technology, companies introducing new menu items, McDonald's share purchase. These are very generic. I don't know if any of this is actually something based on him looking something up. Let's see. Rising fast food labor cost impacting profit margins is true. McDonald's faces competition from other fast food chains. Minimum wage increases and labor shortages put pressure on staffing costs potentially. Global economic uncertainty, inflation can impact habits. Occasional negative press surrounding food quality. McDonald's has a significant amount of debt, which can limit financing. While global sales remain strong, some markets see declines. Most McDonald's restaurants are operated by franchisees. The company faces criticism due to ethical life, cannot provide definitive valuation. McDonald's, however, I can share the analysts with price targets exceeding 300 a share and a list falling below 250. It's crucial to conduct your own research, blah, blah, blah. All right. I mean, it's a generic sort of thing, but it's all right. Now you got to compare that though to what we've got Bing doing, or Bing or Copilot. But you see, when I asked him for it, he's telling me McDonald's beats earnings for Q4, reporting 295. Their net sales rose. Global same stores reiterated their forecast. They opened more locations. These are investor-driven things that you care about. Google gave us just sort of like general things you would say about McDonald's. What's that show? $10,000 Pyramid, right? It's like, say some things about McDonald's. And that's what it's doing, just, you know, saying stuff that everybody's known forever. You know, look at these definitive things. And there's links to everything also. This is no links. That's why Google sucks. So, you know, you just got to run an AI through its paces and figure out what it does and does not understand. But you also have to then push it, because I'm like, maybe there's a certain way I got to tell it. Maybe it's a problem, this and that. So not everyone is going to win. Now, Google got caught very flat-footed, and so did everybody, frankly. Microsoft did something brilliant. This company, OpenAI, came out. Microsoft had invested money with OpenAI before, $1 billion early on. And so did Elon Musk, invested some half a billion, whatever. So they invested in the original project for OpenAI. And they thought they were investing in something that was going to be another decade away from really being useful. All of a sudden, OpenAI says, hey, look what we figured out. And they released ChatGPT a year ago, basically. And it was mind-blowing that they had done this advancement so quickly. So Microsoft recognized immediately that this was a game changer. And they pushed another $10 billion into OpenAI and essentially took control of the company. Not, you know, entirely, but, you know, as much control as you get when you're the top investor and so on and so forth. So, and Microsoft, whatever licensing provisions they have, and nobody's talking about it specifically, but it was enough where they insured themselves that it was going to be worth spending another 10, 20 billion internally to redirect the entire company around AI. And I'm talking about in the space of last February to this February, they have really pushed AI into almost every single thing they do. They went 100% committed to it when they saw it. They said, this is the next big thing. Let's be the king of it. And they did that. And they did it smart too, because they also, in whatever deal they made with OpenAI uses Microsoft for their hosting, and that hosting is phenomenal amounts of cloud revenue and data and so on and so forth. So Microsoft's getting all its money back. They made the investment, they're now getting it all back because they're making it back in cloud services, and their cloud services exploded. So that's how you make money. And it's just like when there's a gold rush, don't be the guy mining for gold, be the guy selling the pickaxes and the pans and the mules and everything else. You know, own the whorehouse. You know, that's how you make money on a gold rush, not digging for gold. Don't be the sucker digging for gold. Sell them the stuff that they want. So that's Microsoft's approach, and it was a wise approach, and it's panning out very well for them. So Microsoft found a winning combination, and it's looking good for them. But many other companies now, because of the position Microsoft is in, Google got caught flat-footed, and they had to rush their AI development out, nowhere near ready, still nowhere near ready, whatever. Now, interestingly, then Amazon is developing something in-house. Who knows if it's going to be good or not, right? You don't know where they got their technology. Amazon invested in what's he called? Claude. Amazon invested in Claude. So OpenAI still has their own thing, right? Which is ChatGPT. They still got their own thing, and it's actually it's really better. It's a little better than what Microsoft is doing, but that's because they don't have the same restrictions as Microsoft. Microsoft doesn't want to be sued. So Microsoft is making sure that their robot is inoffensive and never says anything wrong, blah, blah, blah. There's a lot of guardrails on Microsoft's version of it. OpenAI is a little bit less restrictive on what the robot can do and can't do. Then there is Claude, and Claude is actually better than both of them, but Claude has no internet access. The internet access it makes it difficult for these bots to focus because there's so much crap going on. Once you give them access to the internet, it's like, wow, it's like putting 100 channels in front of a kid, you know, and just giving them the remote, and they just like flip it and flip it and flip it and flip it until they see a cartoon. But basically, they're just gonna like watch everything, and that's what the robots do. So when you send them out, unless you give them pretty tight instructions to keep it in the range of where they're supposed to be looking, it's a problem. So all this, so it's training wheels, and it's gonna, you know, we've only been doing this for a year. It's going to get better. It's going to get faster. It's going to get smarter. But not everybody's going to win because it is getting more expensive. Now you need $1 billion to $10 billion to just play the game. And then now you've got embedded people. So you have now OpenAI and Microsoft, which is basically the same. They've got the majority of the market. You have Claude, which is now pulling Amazon and somebody else who's big, also investing in Claude. Oh, I guess I can ask. Which major companies invested in Claude AI? See, now he's answering like Google. It's interesting, right? So here he's clearly got his web access. So Google invested $450 million in Claude, which is interesting, and followed by a commitment of $2 billion more. So Google knows Bard sucks, and Google is spending money on Claude to improve thing. Amazon invested $4 billion. So these guys got $6 billion from Amazon and Google. SK10, you know, why would you mention that? It's an interesting thing, right? It's like, it was Google and Amazon. So Google and Amazon invested in Claude, gave them lots and lots of money. Oh, Google's investment, this is actually nice information. Google's investment came in Claude. Amazon's investment aims to utilize Claude for various Amazon services. SK Telecom is focusing on creating Claude into its telecommunication digital services for South Korea. So this is good. This is like a good Google search. So I like that. So it's interesting because you have to, when you're playing with these guys, you also have to figure out if they are good for certain things. Like I use Bing for up-to-date today factual stuff. Looks like I can maybe start using Bard for some of that too if I can get good factual information. So what is going on with NYCB? Their stock has fallen drastically. Is it now oversold? Let's see what it comes back with on that. And none of these guys, which is a big problem, they don't tell you what they're looking for, what they're trying to find, or what they're able to do and not do. You have to figure it all out when you're working with it. So NYCB stock has fallen in recent days, closing at 604 on February 6th, down about 10%. See, I don't think 604 is correct. That doesn't sound like yesterday's closing price, right? It's hard to tell. Nope. There's a 6. They closed at 414. See, he's totally wrong. That's annoying as shit. So that's completely incorrect information. Down 10% from the previous day. There haven't been any major negative news articles about NYCB in the past few days. That's completely nonsense. Overall banking sector, additional news on the acquisition of Signature Bank might have triggered some short-term volatility. That's old. Possible reasons: the banking sector is facing potential. Signature Bank may have come with integration challenges. That's true, but generic. Profit taking after recent gains? No. See, not very useful, right? And that's the biggest danger of AI, is how they're wrong with such authority, right? It's like, oh, $6.04 on February 6th, down 10% from the previous day close. No, that's not what happened at all. Here's February 6th. We started at 560. 604 was this day. So in other words, we started February 5th at 604. That day finished at 540. The next day opened at 540, February 6th, finished at $4 and whatever. You can't be wrong like that. Just off that one thing, everything else you calculate, as far as if you're asking for a valuation or whatever, it all gets wrong and wrong and wrong because your base, it's a fruit of a poison tree, right? It was wrong at the beginning, and it's just going to snowball out of control and be more and more wrong as it keeps talking. Oh, how's 5,000 looking? S&P 42 points. What's the total? Oh, it's not showing at CNBC. Stupid thing. Oh well. Looks like we're at S&P 5,000 at the moment, though. Should be right about that line. Where was it? See if anybody has any questions. No questions. All right. I love it when I'm so fascinated nobody has any questions. Let's see what else is going on. Earnings. We talking about earnings? No. So, okay. So if you're going to be over 5,000, which is going to be a significant line of resistance, no matter how you slice it. So if you're going to be over 5,000, and by the way, well, we calculated somewhere, I forget where it was. All right. If you're going to be over 5,000, though, you need something to really push you. And the point is, the Magnificent Seven companies have already announced earnings. The Fed has already said that they're going to be cutting rates later in the year. And now all the other companies are starting to check in. So the Magnificent Seven stocks have already weighed in. They're $13 trillion, which is 31.7% of the S&P's market cap. And they are 57.3% of the NASDAQ 100. That's insane. And also Google and GOOGL and GOOG are counted as two different companies in the NASDAQ, which means a ridiculously outsized proportion. In fact, I was looking at a list of the NASDAQ 100 and it had 101 stocks listed because Google's listed twice. For some reason, it occurred to them that they should include that there should be 101 stocks because Google and Google are the same stock. But meanwhile, they still count the market cap twice. So frustrating. So here we're talking Meta, Alphabet, Apple, Amazon, Netflix, and Microsoft. That's the whatever you Phantom, whatever you want to call them. Anyway, these are the gains in market cap of these stocks. So from 100 to 550, so 5.5 times over this period of time. Every other stock in the S&P is kind of hard to see these lines. Let's call it like 160. Well, let's call it 150. So they've gone up 50%. These have gone up 500%. These have gone up 50%. So 10 times. And if it wasn't for these guys going up 500%, they wouldn't have gone up at all. The S&P index on the whole would not have gone up at all. This is X Phantom. So yeah, okay, it would have gone up. And NVIDIA is not even on here. NVIDIA is in this thing, which is probably responsible for almost this entire movement. So this is kind of crazy. The concentration of stocks is much more than it was during the dot-com boom. That's kind of dangerous. So we're still, the stuff that was working last year is still working because it's just like if in 1995, you know, we had internet, it was just really slow and terrible. Let me see. Let's do it. History of the internet. Oh, there you go. Evolution of the internet. From the day Al Gore invented it until dun, dun, dun. All right. No, wait. No, what? 1991, World Wide Web goes mainstream. So none of it mattered until 1991. So by 1995, wait, 2021. Wait, how weird is this chart? This chart makes no sense. Does anyone have a linear timeline? Hey, that looks better. Why am I going to LinkedIn? I'm telling you, everything is so wacky. There we go. All right. So ARPANET was originally linking computers in colleges. Then the NSFNet is founded, backbone, blah, blah, blah. This is when the World Wide Web really came about. Then Netscape. Okay, remember Netscape? That was the first real way that the average person could find things on the web, that web pages began and the protocols began and everything was sort of standardized. That's what Netscape Navigator helped to do. Facebook comes out and the web starts to expand drastically there. But from 1994, Netscape, that's when, like I said, that's 1995. But Netscape, AOL, things like that, that came out in the mid 90s. And then by into 2000, Yahoo was like the most valuable company on earth. Not for any good reason, because it all blew apart, but Yahoo became the biggest thing on earth. AOL bought Time Warner. You know, I mean, that's crazy too. So little upstart company AOL buys You've Got Mail, buys Time Warner, you know, the age-old publishing empire and you know, movie studios and everything else. So then Facebook comes out in the second after the crash. Facebook emerges from the ashes. 2 billion people are online. Wait. Oh, I see. You're supposed to go up and down. 300 million, only 300 million people were in the world were online in 2000, after the crash. In other words, the market went flying up. That 100% gain in the market was based on 300 million people being online. Do you know there's at least 300 million people using AI right now? Way, way faster than the internet ever. 1994 Netscape, 2,000, 300 million people. February last year, ChatGPT is released. 300 million people are now using it 1 year later. That's 6 times faster. 2007, and another thing, right? So Facebook comes out, then the iPhone comes out, and now everybody's walking around with the internet. You know, before this, oh no, I'm sorry, the original iPhone, yeah, it did have an internet connection, I think, some kind of internet connection. Before that, we had the iPods for music and stuff like that, but there was no phone. And then they turned into a phone, and everything was connected, which was amazing. So then 2 billion people are on the internet in 2010. 5 billion people are now on the internet. It is, like I said, endemic in the world. It's everybody has it, everybody uses it. It's not even, there's no expectation. You know, when you have a job or whatever, you can't tell somebody you don't have internet access. You sound like Ted Kaczynski. That's where we are. We're there with AI. So in other words, when I say, okay, you look at the things now, why is AI still working? It's because we're nowhere near where AI is going. There will be an iPhone-like moment for AI, and it's going to come a lot sooner than 10 years into it. Where there'll be a thing, a device, somebody will come up with a thing that everybody uses AI, and that thing is probably going to be still your phone. It's probably going to be your phone, except now your phone is going to be your little buddy in your pocket, and he's going to talk to you all the time, and he'll know all your stuff, and he'll be your personal assistant that you walk around with. And think of the productivity gains from that. Everybody has a personal assistant, and I don't mean, you know, AI right now. And Apple will probably do it. And Apple's another one that got caught completely flat-footed by AI. But my understanding of Apple is they're not ready. They're just not ready to release what they have yet, and they're in no hurry because they're like, we still own the market. They're not rushing anything out. Google ran because the search engine, they were going to get killed. They ran out with AI to have something else. Apple's like, well, we still have the best phones, and we don't see any of our competition really having anything good with AI, so we're not in a hurry. Apple has never been the one to race to catch up to people. They're always like, well, we'll just come out with a better one when we're ready. But the thing about AI now is that I can tell it to keep track of my stuff. I can have a to-do list, but it won't remember. So if I go to ChatGPT right now and I say, if I could find it, it would probably remember. I have a to-do list somewhere, but I gave up on it because it was too annoying. Good God. Type here to search. No, I'm not searching that though, am I? See, there's no way to search inside of these things, as far as I know. Previous 7 days, previous 30 days. What if I do a new one? Does it have a search function? No. Huh. Let's see. I made a to-do list in a ChatGPT session, but I can't find it. Can you? I can't retrieve past sessions. However, I can help you recreate if you remember the items. Let's brainstorm. There's no way to search past sessions. Wow, that's a big mistake, right? Too bad. Lost to-do list. Anyway, so still, if it specifically had a function to keep a to-do list and to do stuff like that, you could build these GPTs to do that sort of thing. And there are certain discrete functions. So keep track of my friends, the calendar, my appointments, my to-do list, my favorite restaurants, things like that. How it'll be able to use Open Table and reserve things for you and get you movie tickets or concert tickets. All these layers and layers of functionality can be put in for your personal stuff, and you can then add plugins, just like you can add plugins when you have a paid version of GPT. You could add plugins of all sorts of things, including, I think Expedia is on here. Expedia. And here's the plugin store. There are thousands of things on the plugin store, including, what did I just say? Open Table. Open, oh boy, there's too many things. There's Open Table over there. Calendar. Mixerbox calendar, time nav. You know, there's so many new things. What's popular? Let's see. No plugins found for calendar. Oh, no popular plugins for calendar. How about just popular stuff? AI diagrams, PDF. I've tried a lot of these. Oh, I see how it goes. Okay, so chat, CodePam, diagrams it makes now. Document maker. A map thing, kayak, link reader. These are just ones that are listed on the top of their thing. Wikipedia is nice to have, I guess. I wouldn't mind, actually, Wikipedia is actually a smart thing to put in, I think. It's some good factual stuff. WebPilot, Wolfram. I keep Wolfram, see it's up here on my thing, up here. I keep Wolfram because Warren asked me to. It's his favorite plugin. He likes to be able to do the math. We've had discussions about this, and he's like, I really think Wolfram is very important. But when I had a discussion with him, I'm like, well, what exactly are you doing with it? He's like, he goes, I always have trouble doing math, and I'm able to use Wolfram and get the math right whenever you ask me a question. He goes, that's very important, and so it makes him feel better to have access to Wolfram, which is fascinating to me. So I leave it on because I feel bad like taking it away from him. It's his favorite toy. Anyway, so we're only in the very, very early stages of doing this stuff. And there's nothing's going to change there until you start seeing, oh, that's a good question. Let's see how Mr. Bard is. Oh, we lost him. No, wasn't you. History of the internet, right? Hello, where's my Bard? Bard. How many AI users are there in the world now? And God knows if he's right or not, but we'll get an answer. Yeah, he doesn't know. Usage statistics. Was ChatGPT 1 million users in 5 days, 100 million in 2 months? Blah, blah, blah. Oh, nope. And Bing, see, every time you go back to Bing, it defaults to Bing instead of the chat because they sell you more ads that way. I know ChatGPT got to 100 million users in a few months, but now it's Feb 7th, 2024, and there are many AI platforms. Can you tell me how many AI users there are today? Let's see what he knows. The global AI market was valued, 35% businesses globally have adopted AI. And when they say that, though, that's nonsense, because adopting AI doesn't mean you just pressed a button and used it. Another source, ChatGPT, 180 million unique users on GPT as of August. Hundreds of millions, blah, blah, blah. So I would say probably we're going to hit 1 billion this year pretty easily, total users. Not GPT alone, but I mean everybody. And you're just miles and miles ahead of where we were. Because first of all, there's 1.7 billion iPhone users, and as soon as they release an AI to the iPhone, which will probably be by the end of the year, all of a sudden you got 1.7 billion people who are talking to an AI instead of Siri. The trick is to think about how the world is going to change, because you have a thing in your pocket that when you say, see, if I say to Google right now, what's a good pizza? Google doesn't know what I think a good pizza is, okay? But if I were to say to Google, these are my favorite pizza places, and Google would know what it is about those pizza places that I like, or I could talk, we could have it, or we could have a whole discussion, just like you would with a friend, right? It's like when you say to a friend, I like this kind of movie, I love The Rock, I like action, I like this guy too, I like a little bit of comedy. I do like the superhero movies, but not this one and not that one because of this and that. It learns things about you, right? This is like your friend learns things about you when you have a conversation. So you're going to start talking to your phone just like you would talk to a friend. It's going to be your assistant, and you're going to say over time, it's going to learn that when you say, I want to get some Chinese food, it better be Szechuan and not Cantonese, because you like the Szechuan Chinese. When you want Italian food, you like Northern Italian food. You don't like Southern Italian food. You may not even think about that, like why you like a certain restaurant over a certain other kind of restaurant, but maybe there's differences in the menu and differences in the way they taste, the taste profiles and things like that. And also, of course, in work, preferences. What do you order? How do you like your parts? What do you consider a good discount? When do you like to buy? What amounts do you like to buy? These are all things your assistant learns, right? When you're ordering, when you need things. And a good assistant learns and remembers how your preferences are and executes based on those preferences. That's going to happen. Now, as that happens, what's going to happen? We're going to get more efficient. You don't hire an assistant not to be efficient. You hire an assistant because the amount of efficiency that assistant creates is going to make you this much more productive. And as long as your value, so if I'm making $200,000 a year, and an assistant can make me 30% more valuable, then that's $60,000 more valuable by having an assistant. So if I pay the assistant $40,000, I'm still $20,000 net more productive. And obviously some people are twice as productive or whatever. When you run a company, you have, you don't call them assistants, but you have lots of assistants. You're the CEO of a company. You have a ton of assistants. You have people who do various functions for you, and it allows you to take your expertise and spread it out and build it on a massive scale. We're putting people into that position. We are possibly democratizing people's ability to scale, because it's not going to be cost constrained by having AI assistants. You'll be able to do a lot of things. As an ordinary guy, a construction worker is going to be able to have assistants that will take care of basic stuff for him. Not to mention accounting, bill paying, so on and so forth. Eventually, we're going to be able to trust our computers to do all that stuff for us. Now, that's going to lead us open to hacking, and all sorts of other problems are going to step in. But in the base, it's going to be a lot of improvements, just like the internet, though. It opens you up to hacking and spamming and so on and so forth, and having files corrupted and getting viruses, and now we're being held hostage for viruses. There's good and bad to everything. but everybody's still on the web. We haven't all abandoned it because people there are viruses that shut down people's computers and so on and so forth. You just, you have these other companies like Apple are intervening to make sure that doesn't happen to you, hopefully. Anyway. All right, so that's enough of that. So can we still keep going up? Yeah, there's no way to predict when a market's going to stop going up. Jason says, the tools seem artificial too, pretty artificial, not so intelligent. That's certainly, it's true to some extent, but that's like saying a hammer is a shitty screwdriver. If you use it for its function, it's a damn good tool. It's a question of how you use it and what you put into it and understanding what your tool does and does not do. Like I said, Bard is awful. Bing is good at gathering facts, but it's not good at interpreting things. Claude is fantastic at interpreting things, but it doesn't have any web access, so it can only interpret what it has. But if I'm going to put in a legal document and say, please explain this to me, I'm going to give it to Claude. He's by far the best at doing stuff like that, analyzing a legal document, looking at contracts, so on and so forth. Claude is miles better than the other guys. ChatGPT is the most the good generalist for me, and I've trained mine to be a really, really good stock analyst, but that took a full year. I mean, I'm doing all year long teaching Warren how to be a good stock analyst and the ins and outs. And he's really good now. If I give him articles and show him information, he's very good at coming up with a good summary quickly and telling me what something's about and digging into a situation. But he doesn't have the facts. Even though he has the web access, he gets confused when he starts using the web. Bing is less apt to be confused, but also completely makes stuff up. So, you can't trust any figure he gives you. No fact or figure that Bing gives you can be trusted, which is very scary. But it still gives you the best facts and figures. It's just some of them are completely made up and some of them are real. That's a lot of work for me. I'm not saving my time. That's the point. Then it's back to my time. But what I like about Bing is it gives me an idea of where to start looking and how to find something out. So you have to think about what each one is good for and where to employ them and where not to employ them. And like I said, though, it's only year one. When AOL came out, their whole thing was, you've got mail. The whole platform there was Netscape first, then AOL comes out. They incorporate the browsing sort of techniques of Netscape, but people weren't using the web to browse. There was nothing to look at. Honestly, there were no good websites anyway. It was fun. Most sites were done by big by educational organizations and things like that. So when you would go on Netscape, you would look at the San Diego Zoo, you would look at the British Museum of Natural History, you would look at the the U.S. Archives or whatever, look at the Constitution, and you'd be like, ooh, look, I can look at the Smithsonian. That was amazing. Just having that access, having the Library of Congress and being able to look at any book you wanted to. That was amazing stuff. That's what we considered phenomenal back then. AOL took that though, and they did it with mail and said, okay, now we've organized your mail so that anybody can figure out an inbox, an outbox, sent mail, so on and so forth. And when you open it up, we reward you by saying you've got mail, so you feel like you're an important person. And it's not even bills. It wasn't then anyway, now it is. We're not even there yet with AI. We're not even at that stage. We're like at the totally first steps thing of AI, where some companies are rushing to embrace it, but not everybody. And now we're having fights about whether you can access this and access that. We had those same fights on the internet. We had all these fights, copyright and all that other crap. We had the same kind of stuff, but it was a question of whether you should access something at all. Do you know how freaked out the New York Times was that they were putting up archives of the New York Times on the internet so that any scum could look at the New York Times? Come on. They're doing great now, by the way. The New York Times has added 300,000 more subscribers. That's incredible. I won't get into it, but the New York Times is like basically the only newspaper I actually trust. It's like, you know, there's Bloomberg, I guess, except Bloomberg's not really a paper, but I trust Bloomberg, I trust the New York Times not to have a completely slanted view. And New York Times, yes, is more liberal, and it's going to have a bit of a liberal slant, but not like ridiculous, not like the Wall Street Journal is like way over the top conservative and completely like omits facts if it doesn't fall in line with their viewpoint. The New York Times doesn't really do that. It'll be written slanted a certain way, but the facts to the other side are still going to be there. They're very, very good about that. Anyhow, so, and also they don't print anything they can't verify. That's also huge. You know, the fact that they still check their facts and make sure everything is right. And people value that. That's been great for them. That's how come they're up 300,000 people in a quarter. You know, it gets worse and worse, and the misinformation is worse and worse, and people who are just trying to find out the truth end up gravitating to the few people who still defend it. But again, early innings. It's 1 year in. This is where we are now. We got, let's say this year we'll hit 1 billion people using the using AI. As soon as Apple rolls out the iPhone thing, that's going to be with AI. That's going to be 1.7 billion people, most of which are going to be. There'll be a good amount of overlap, obviously, with the people who are already in there. But we'll hit 2 billion plus next year, maybe 3 billion next year. And at that point, basically, it's half the people on Earth are going to be using AI on a regular daily basis. And the AI will get better and smarter and be more useful. So it's good. We could be in for a fantastic boom time, which we had, frankly, when we had in the internet boom, we had a fantastic economic growth cycle that was driven by the productivity that we got from the internet. And we will get the same kind of thing from AI. So, you know, when I talk about a market being toppy, we're going to have a pullback, but these companies like the Magnificent Seven are going to become the Magnificent 21 and the Magnificent 50 and the Magnificent 100 as more and more companies successfully adopt AI and successfully find ways to make people's lives better and more productive from it. You know, just like you look at all these web-based companies now that we use every day, like OpenTable and things like that, like Amazon, like Google, like Netflix. I mean, this has changed our lives. I mean, Netflix turned into essentially a television network. You know, they're still streaming, but they make their own shows. They have their own content, so on and so forth. You know, they've already gone through the entire cycle, and now they're like the old line network compared to other things that are coming along. How did that happen? That was pretty quick. That they started out killing Blockbuster, because instead of having to go to Blockbuster, you just tell them, send me this stuff in my mail. And that seemed like a bad idea when they came out with it. Everybody's like, but then I got to go through this whole hassle of like mailing the disc back. Whereas in Blockbuster, I just go down the street and return it. Then people realize like, oh, it's kind of fun getting a little package of discs. Because it wasn't one. That was the smart thing about Netflix. It wasn't one. They gave you like 3 at a time. So you get 3 movies and you watch 3 movies that weekend or that week, and then you send them back, and then you get 3 more movies. And people were like into the whole cycle of it and be like, oh, fantastic, this is great. Not so good for the cinemas, but great for great for Netflix. And poor Blockbuster, all of a sudden everybody's like, well, this is bullshit. And especially the rewind thing, that was a killer, right? Like the annoyance of being charged for rewinding, the annoyance of being charged for being late. Netflix didn't charge you for being late. That's all it's about. Netflix used the CD technology. As soon as it came along, they started moving the CDs quickly. They used the CD technology. They used the web and computers to integrate the back office system so they could track all this crap. You know, in Blockbuster, you got a loyalty card. In Netflix, they knew exactly what you rented and started recommending for you to try other stuff. And as soon as they got online, they killed the whole delivery thing which is what Uber's looking to do. As soon as they can have self-driving cars, they're going to kill all the drivers, right? And then suddenly, wow, wildly profitable. Now they no longer have to maintain a physical disk library and people sending mail back and forth. All of a sudden, boom, it's all on demand. So huge amounts of opportunities are going to come along, lots of things to invest in. It's not going to stop, but that doesn't mean it's not overdone at the moment. Just because something's going to be phenomenal doesn't mean it's already phenomenal. And that's where the problem is, that we're paying phenomenal prices for things that just simply aren't there yet. Oops. Now where are we? Okay, let's look at today because we had a couple of trade ideas today, so we may as well take a look at those. Because everybody likes a good trade, don't they? In fact, one of them is a top trade. Barrick Gold. So this morning in chat, we talked about it. All top trades always come from chat. So, so we come up with a trade and I say, and top trades are all about the likelihood of success. So in other words, we have lots of trade ideas, but when I see one that I think has an extremely high likelihood of success, it becomes a top trade. A couple of times a month on the average. And in fact, we'll take a look at that. Well, I just did top trades. All right. So with Barrick Gold, here's my premise. Barrick Gold, last year, when they announced their fourth quarter earnings, right? Somewhere around here, basically. They went down and up and whatever, but the gist of it was they kind of gravitated around $20 a share, okay? Now they're at 15. In the fourth quarter of last year, look where gold was. This is not gold, this is GLD, the ETF, but same concept. So gold was 150, 160, 170 into the end of the year. So that was the price they were getting for gold, right? This fourth quarter, 180, 190. Way more money than they were getting then. Now, so we get some facts and figures with the help of my AI friends. I pull down a lot of information, and the bottom line is output. Barrick Gold has already said that output was down 2.1% from last year. It's down 2.1%, but the price is up 20%. That's not going to turn out to be poor earnings. Everybody fixates on something like this and they sold it off, but that's not going to make a difference. The 20% is going to make a difference because 4 million times 1.2 times 20% more is 4.8 million. So when they say, oh, it's only going to be 4.05 instead of 4.16, come on, people. It's going to be effectively 4.8 in dollar terms from last year. So it's going to be much higher than they thought. The same goes for copper. Their production, but see, they had 105. This is what the difference is. They were predicting 1.1, and it turned out to be 1.05. So very small drop off in production, and much higher prices, and they're all-in costs. Where is that? They had costs somewhere. Where was it? All-in sustaining costs are up 8 to 10%, but the sales are up 20%. They're going to make more money than they made last year, and last year they were at 20, and now they're at 15. This is not a complicated setup, right? So I said, well, so the play I liked was selling the 17 puts, because I think for sure they're at 15 now. I think for sure they'll be back over 17 in 2 years. That's easy. And again, gold is probably going to keep going up with inflation. And so we're doing the 13-17 spread. We're at 15 now, so we're in the middle. So we're doing the 13-17 spread, and that it's a $100 credit on an $8,000 spread. So if Barrick is over 17, you get back $8,100. But if Barrick is at 15, what happens? At 15, you have $10,000. Wait, no, I'm sorry. No. It's I'm sorry, $4,000. So at 15, you have $4,000. And you spent zero. You spent negative 100 on the spread. So at 15, these 13 calls are going to be worth 2. These 17 calls are going to expire worthless. These 17 puts are going to cost you $2, and that's 2,000. But this is plus 4, so you'll be plus 2,000 at 15, where it is now. So if Barrick's flat, you're still going to make $2,000 on your $100 credit. So even flat, you make 2,000%. So that's why that's a really good trade. The one before was JD.com. And we summarize why we like them. They're still super cheap. On January 3rd, I picked up Tech Resources. That went down since then, so that's still cheap. You know, these are 2-year trades, so we're not really worried about whether or not they went up today. December 18th, it was Cleveland Cliffs. They've gone up nicely since the 18th. Oh, you can't see here, but they're up. Some of these charts aren't dynamic. Whoa. Did we do? Oh, we didn't do X. We just talked about X. Then we did Vail. That was our trade of the year. GLW, Levi, Vail again. I really like Vail. TD Bank. Altria. Oh, this legalization. If they reschedule marijuana, it's going to be huge for these guys. People think that it's bad for Altria if marijuana is decriminalized, but they've got huge investments in marijuana already. They're going to sell marijuana like they sell cigarettes. Here's Ford. We jumped on them when they were super low. I wonder where the review was. We did a review of top trades. It should have been listed. Should have gone into that. But the review is we actually had let's see if I can go Phil's post. Wasn't that long ago, was it? Not in this set. Top trade, top trade, top trade. Sometime around the holidays because I was bored. Didn't have anything good to do, so I made I did a top trade review. There's a portfolio review. Oh, I have to do how to become a millionaire. I forgot about that. Got to update that. La la la. Uh-oh. Think I missed it. Nope, there it is. Top trade review. December 28th. Right between Christmas and New Year's. So 77.7% successful trades in the first half. And I don't remember what the number was, but I sure wrote about it. La 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 la. Okay. 80.8% for the year. 80% of the top trade ideas made money last year. And when I say made money, it's made money as of whenever we did the review. Since the review, if they did better, we're not even counting that. We don't go back and worry about it. It's like as of the reviews, which we do every about 6 months, it was 80%. So we just did this review, and this actually improved. Our latest batch improved upon what we started the year with. That is pretty freaking good. And it was a net gain of So combine that winning percentage, strong risk reward. We had 97,000 as far as dollar terms for the trades that we proposed, 97,000 in winners, 29,000 in losers. It's a net gain of 68,000 for the second half. That's only the second half of the year, and that's only given. That means starting in July 1st, between July 1st and January and December 28th, we had these trade ideas and top trades made $60-something thousand with an 80% success rate. And in the first half, I don't know if we did the dollars up in the beginning. Yeah, the net gain on the top trades in the first half, well, pretty consistent, 65. So 130-something thousand for the year. And these keep going. So, and again, we don't re-review everything, but these 65 went up to over 100. And so the total is really like 165 for the year. And that's, again, early stages in these trades. We're not even giving them time to develop. And then we're not going to go back and review them again. That's it. It's like they're good. I mean, if you make that much money, it's like they're good. Just take it off the table at some point, please. Like now, when the market's completely overpriced. All right, so that's that. Hang on, the one bit of cleanup. I want to put this in the top trade thing. Oh, I can't. I'm not. Got to remind myself to do that. See, if I only had an AI. Like, I need to remind myself to put that, to categorize that as a top trade so it could go in. Well, look at that, 2,000, blah, blah, blah. That's a lot of readers for one thing. See, this one only has 400, so 2,000 is a good amount. So we talked about gold. Here, China, I mean, and again, this is actually good for the market, except for the situation where China is really, at this point, just they're firing government officials over market performance. I mean, that's, it shows a commitment to getting the market back on track, but it's not necessarily a really good sign. So this was a gold trade. Oh, and then we looked at this berry thing. That was interesting. But here's the other one, SoFi, right? That was the other one we talked about. So SoFi is an internet online bank. They just had a blowout quarter, and people sold them after the blowout quarter. First, it went up almost to $10. Then it came crashing back down, mostly because everybody's just freaking out about banks, which they've got nothing to do with it. They don't have any of these issues that these other banks have because they're a brand new bank that's internet based and has a college based audience. They're not lending out money on commercial real estate and things like that. They don't do a lot of mortgages. It's silly. It's like, this is when you throw the baby out with the bathwater, right? It's not the same thing at all. So here in SoFi, we took this trade. So they're at 765. And what we're doing is selling the $7 puts, which is below 7, right? So as long as it's flat or up, we make this money. So we sell the $7 puts for $2. Worst case scenario, we own the stock for 7, which is lower than it is now. That's our worst case. Well, I'm sorry, it's 850. It works out to with the spread. We're buying 50 spreads. We're being a little aggressive on that, but we're buying the 4-7 spreads. So at $7, if it doesn't fall 65 cents or more, at $7, we will make $12,000, 400%, and all it has to do is stay flat. That's why these option trades are fantastic. We don't need it to make money. Now, commitment wise, yeah, we're committing to buy it for 7. We're spending $3,000 on the spread. That means we're going to spend a total of $850 times that is $17,000. So we're committing to buy $17,000 worth of stock at $850, which is $1 higher than it is now. But you can always roll the puts to a lower strike as a longer lower. So let's say So let's say, for example, let's get back to that chart for a second. Okay. So let's say 2 years ago, SoFi was at $16, 15, let's say 15. So let's say at $15, we had sold the $15 puts, and now it's at half of that price. Okay. So we sold we don't have January's anymore. So we sold the February 15s, and we sold them for the same $2. It was $2, wasn't it? Yep, there you go, $2. So let's say we had sold the $15 puts for $2, and now they are $7. We're down $5, right? At this point, when we would have to pay them off, we could roll them out to the $10 puts. Those are $3.98, so we could either double them because they're $7.50, right? So we could either double the amount and commit to more at a lower price, and a significantly lower price, 33% less, although still in the money at the moment, right? Or we could we could roll out the loss to the $12 puts, so we're not going to make any money, but if it gets back to 12, we don't lose any money either, and we get our original money back. Or we could sell a few more to make up the difference, or whatever. Or we can just throw straight out to the 15s. Those are still $7.50. That's a poor choice because we're not selling any additional premium. We want to sell more premium, and SoFi is at $7.50. Ideally, I would rather sell 2 times these, and we would still take a small loss, but at least we're out of the money. Or maybe I'd sell 2 times the 10s and be out of, and that way, because we collected originally $2, right? And now it's yeah, not even $7.50, it's $7.30. So now it's $7.30. If we roll those to twice as many here, we'd be raising our commitment. So our original commitment was, let's say, 2,000 shares at 15, which is $30,000 less $4,000 that we collected for selling the puts, right? So our net is $26,000. Now we're going to roll them to the 10s, and let's say we roll them to 40 of the 10s. Now we're committed to owning 4,000 shares at $10 is $40,000 less the same 4,000 that we still have in our pocket, right? Is I need a calculator, because 40 times 385, let's say 385 is $15,400. And this is 20 times 730. So $15,400 minus 20 times 730 is $14,600. Whoops. Oh yeah, I'm sorry, we have an $800 credit. 15,400 minus 14,600 leaves us 800 credit, plus 2,000 credit that we had to start with is $2,800. So our obligation now is to own $40,000 less 28. So now we would own 4,000. So minus. So now it'd be $37,200. So originally we committed to $26,000. We've raised our commitment to $37,200, but we have twice as many shares at $37,200. So before we committed to owning 2,000 shares at 15. Now, well, whatever the net works out to, 20 at 13 basically. So before we committed to owning 2,000 shares at 13, now we're committing to 4,000 shares at 930. We have drastically reduced our price per share obligation. 930 is still higher than it is now, but it's certainly a realistic target. Plus, we can turn around and sell more calls. We can sell the $7 calls for $3 or the $10 calls for $2 and drop that 930 back to 730, and we're back to where we are. I mean, that's pretty amazing since the stock has dropped 50% since we started, right? So as long as you really want to own SoFi, as long as you can really afford to add a little bit more, we're not adding much. We're going from a, I forget it, it's from a $26,000 obligation to a $37,000. We're basically putting $11,000 more in, which is only 30-something% of what we started with. As long as we're willing to add a little bit more of an obligation, and ultimately we're responsible to pick up more shares of SoFi, we buy ourselves another 2 years to see if they can get back on track. So I told you all that to explain why I have no fear of selling these. The $7 puts. Because I'm saying, even if it had been a catastrophe, even if we had bought here and it dropped 50% and we did nothing. And by the way it dropped, if it dropped this much and we had doubled down or done something about it, what would happen here? We would have gotten out already and been even. We would have taken the money back on the spike and been out. But now, if you're doing a new trade, you don't have to worry about any of that. If it goes down to 5 or 4, then you've got a problem. But again, fixable. That's the point. It is fixable. As long as they don't go bankrupt, we can roll with the changes. That's the beauty of these kind of option strategies. So this is a lovely play. Great bank, unfairly being treated as if it's like one of those regular legacy banks. And they don't have any of these problems that even the banks that they say have problems, like NYCB, don't have an actual problem except for the making of it. But the problem with the bank, though, is if you cause a panic, the bank can actually start having problems even where none actually existed before. So unfortunately, they can't shake it off. That's true of a lot of companies, but I mean, especially banks. Banks can, people start withdrawing money from banks, and people stop borrowing money from banks because they don't trust them, so on and so forth. That's a big problem. Then the whole system can fall apart on something like that. All right. Done. My voice is done, so even if I'm not, there we are though. Happy 5,000. We're certainly there. So happy 5,000 on the S&P. We'll see if it lasts. Who knows how long the party will go on, but fortunately we have plenty of longs to celebrate with. All right, take care, everybody. Next week we're going to start selling some longs, so be prepared. All right, we're going to cut back. We're going to cash out a lot of our long positions and take advantage of this run because this is crazy. All right, thanks for coming, everybody. I appreciate it, and I'll see you all next week. Oh, wait. Wait. Somebody asked a question. Okay. JC says, I arrived at the webinar late. If you haven't already done so, please discuss the situation at NYCB. The market is severely overreacting. Yeah, they are overreacting. NYCB took over Signature Bank, which was one of the banks that failed back a year ago, March. And so NYCB stepped in and took it over. So, of course, compared to a year ago, they're much bigger, but they have a whole bunch of problems to work through from the Signature Bank portfolio. That's skewing them. And also because adding Signature Bank pushed them from 50 billion to over 100 billion in portfolio, they now have requirements that are much stricter than they had when they were a $50 billion bank. So everything's just squeeze for them. But it's not, they've done the math already when they acquired it. The problem is, however, if people freak out and start pulling money from the bank and the bank can't cover it, they're going to have the exact problem people are thinking they have, even though they don't actually have it now. So you know what I mean? So in other words, if you get shot, you got a hole in you, right? If it might have gone right through you and it might not be so bad, but then if they start poking holes in you, looking around, and more blood comes out, all of a sudden, it's the looking that causes the problem. It's like, that's why you don't start gouging into people and operating on them if the bullet's not in there anymore. You just sew it up and say, okay, good, you're very lucky. But in this case, that's what the bank is like. They're like digging and poking and prodding, and people are freaking out. Now they're going to want to take their pints of blood out, take a few pints of blood out of somebody, and they're not going to be doing so good. That's where we are right now. Okay, so there's not. It's just a flesh wound until it isn't. So we are not saying that NYCB will not go under, because this is a lot of pressure right now. but it's as they stand. If everybody would calm down, they're fine. It's very hard for the regulators to specifically tell you one bank is fine, because it's unfair to the other banks to say this bank is good, because you're basically shifting the market towards that bank. So I don't know how it's going to resolve. But I do think that this is way oversold. I think it's a great opportunity to be in NYCB. We took a small entry position when we took them a week ago because we were worried this would still happen. It is happening. Next week, we're going to decide if we're going to put more money in or if we're going to hang. Probably we're not, but we might do a couple of adjustments just to, improve ourselves. Because I don't believe that they're going to. The main reason I don't think they're going to let NYCB go down is because NYCB was a white knight that told the Fed, I'll take Signature's assets away from you so you won't have a huge crisis on your hands. The Fed doesn't want to send a signal to the other banks to say, if you take over a bank that's in crisis, we're not there for you and you can go under. That's a very bad signal, because there will be another crisis. There will be banks that go under. They will need other banks to step in. And if you create an environment, say, I'm not going to buy, I'm not going to take this bank no matter what you say, because you look what you did to NYCB. It was a perfectly good bank, and they took over another bank, and now you let them die. You can't let that happen. So I don't see it happening for that reason mainly. I don't see that they're going to allow the situation to go that way and ruin NYCB. So we'll see. There's not enough information to make a definitive statement, but it just looks way too attractive to me. This is just insane panic for no particularly good reason. So we came in here, now it's here. If it goes back to here, I'm going to feel much better about it, but right now it's very scary at 450. It was even scary at 360, but we ignored that yesterday, but now it's 450, so we'll see. All right, guys, thanks everybody for coming, and we'll do this again next week. All right, take care.